what Japan's February 8th decision means for your money and why nobody's talking about it. In just a few days, on February 8th, 2026, Japan is about to make a monetary policy decision that probably won't make headlines in your country. But here's the thing. This decision could directly impact your wallet even if you're halfway around the world. Let me tell you why. Japan holds approximately $1.2 trillion in US Treasury debt, making them America's largest foreign creditor. Right now, the Japanese economy is trapped between two forces that simply cannot coexist. A debt load so massive it makes America's debt look small, and an inflation problem they haven't dealt with in decades. Whatever choice they make could shake up US interest rates, stock values, and the dollar's purchasing power. And if you think this doesn't affect you, just wait. We've already seen this play out multiple times over the past 18 months. Japanese monetary policy decisions have moved American markets in ways that caught most investors completely off guard, and it's about to happen again. Over the next few minutes, I'm going to break down exactly how Japan got into this mess, why their decisions directly impact your investments, and what you need to understand about this connection. This is the kind of stuff the financial news won't explain to you because it's too boring for clickbait, but too important to ignore. So if you want to actually understand how the global financial system works, instead of just reacting to headlines after it's too late, stay with me. And if you find this valuable, hit that like button, because it tells me you want more deep dives like this. Let's get into it. How Japan created their own trap. To understand what's happening on February 8th, we need to understand something most people don't realize. Japan's economic problem is almost the opposite of what most countries face. For decades, Japan wasn't fighting inflation. They were fighting deflation. Now we all get inflation. Prices go up, your money buys less. Pretty straightforward. Deflation is the opposite. Prices go down. Your money buys more over time. That sounds great, right? Who doesn't want cheaper stuff? Here's the problem. When prices are falling, nobody wants to buy anything today. Why would you? If a car costs less next year, you wait. If a house costs less next year, you wait. If everything gets cheaper over time, the smart move is to delay every purchase. But when everyone stops buying, businesses can't sell products. When businesses can't sell, they fire workers. When workers lose jobs, they spend even less money. Prices fall further. The cycle accelerates. This is called the deflation trap, and Japan has been stuck in it for over 30 years. Here's what makes this truly dangerous. When prices fall, asset values fall. When asset values fall, the collateral backing bank loans loses value. When that happens, banks become undercapitalized. When banks are weak, credit freezes. When credit freezes, the entire economy stalls. Japan experienced this nightmare in the 1990s after the real estate and stock market bubble exploded. They've been trying to escape ever since. The solution that created the problem. To fight deflation, Japan deployed increasingly extreme monetary policy. We're not just talking low interest rates, we're talking about negative interest rates. Let me make sure you understand how crazy this is. With normal positive interest rates, you lend someone $1,000 and they pay you back $1,050. You earn $50 for lending your money. With negative interest rates, you lend someone $1,000 and they pay you back $950. You literally pay for the privilege of lending money. Why would anyone do this? Because in Japan's case, the biggest buyer of Japanese government bonds was the Bank of Japan itself, their central bank. They were willing to accept negative returns because they're not trying to make a profit. They're trying to stimulate the economy. For years, this seemed to work. The Japanese government could borrow at negative rates, keeping their debt costs manageable despite an enormous debt load. And investors looking for any positive return went elsewhere, often buying US Treasury bonds. But here's the thing about economics. Nothing is free. Every policy has consequences, and Japan's consequences are arriving right now. Here's what makes this truly dangerous. When prices fall, asset values fall. When asset values fall, the collateral backing bank loans loses value. When that happens, banks become undercapitalized. When banks are weak, credit freezes. When credit freezes, the entire economy stalls. Everything changed. After 30 years of fighting deflation, Japan suddenly has inflation. Global supply chain chaos, energy price shocks, and years of money printing all combined to push Japanese prices higher. Not crazy high by our standards, but high enough to create a massive problem. Because the tools that worked against deflation, printing money, negative rates, aggressive bond buying, those same tools make inflation worse. They're gasoline on a fire you're now trying to put out. So Japan faces an impossible choice. They can keep stimulating the economy, but inflation gets worse and destroys people's purchasing power. Or they can tighten policy and raise interest rates, but risk triggering the exact deflationary collapse they spent 30 years trying to prevent. Neither option is good, both are dangerous, and here's why it gets even worse. Japan's debt makes tightening extremely risky. Japan's government debt sits at roughly 240% of their GDP. For context, the United States, which everyone says is drowning in debt, is at about 120 and 125% of GDP. Japan's debt burden is literally double America's relative to the size of their economy. When your debt is that massive, interest rates matter enormously. Even small rate increases create massive increases in debt payments. If Japan raises rates significantly to fight inflation, the cost of paying interest on their existing debt could become unmanageable. They'd have to borrow more just to pay interest on what they already owe. But if they keep rates low and keep printing money, inflation destroys the yen's value, and Japanese citizens watch their purchasing power vanish. This is the trap, and February 8th is when they signal which path they're choosing. Why this matters to you. Now let me connect this directly to your money, because what happens in Tokyo doesn't stay in Tokyo. There's a financial mechanism called the yen carry trade that's been one of the biggest sources of buying pressure in American markets for years. Here's how it works. Japan had the lowest interest rates of any developed country. You could borrow yen at essentially zero cost, so hedge funds and banks borrowed massive amounts of yen, billions and billions worth, paying almost nothing in interest. Then they converted those yen into dollars and invested in American assets, stocks, real estate, corporate bonds, whatever offered a positive return. Japan's government debt sits at roughly 240% of their GDP. For context, the United States, which everyone says is drowning in debt, is at about 120 to 125% of GDP. Japan's debt burden is literally double America's relative to the size of their economy. When your debt is that massive, interest rates matter enormously. Even small rate increases create massive increases in debt payments. If Japan raises rates significantly to fight inflation, the cost of paying interest on their existing debt could become unmanageable. They'd have to borrow more just to pay interest on what they already owe. But if they keep rates low and keep printing money, inflation destroys the yen's value, and Japanese citizens watch their purchasing power vanish. This is the trap, and February 8th is when they signal which path they're choosing. Why this matters to you. Now let me connect this directly to your money, because what happens in Tokyo doesn't stay in Tokyo. There's a financial mechanism called the yen carry trade that's been one of the biggest sources of buying pressure in American markets for years. Here's how it works. Japan had the lowest interest rates of any developed country. You could borrow yen at essentially zero cost. So hedge funds and banks borrowed massive amounts of yen, billions and billions worth, paying almost nothing in interest. Then they converted those yen into dollars and invested in American assets, stocks, real estate, corporate bonds, whatever offered a positive return. Think about the math. If you borrow money at 0% and invest it at 6%, your return is infinite. You're making money on borrowed funds that cost you nothing. This trade was enormously profitable, and it was enormous in scale. Much of the buying pressure that pushed American stocks higher from 2022 through 2025 came from this carry trade. It wasn't just Americans buying American stocks. It was global capital funded by cheap Japanese borrowing flooding into American assets. Now here's why Japan's February 8th decision matters to your portfolio. If Japan raises interest rates significantly, the carry trade becomes less profitable or unprofitable entirely. If borrowing yen now costs 2 to 3% instead of zero, the math completely changes. When the trade becomes unattractive, new money stops flowing into American assets. And when existing carry trades get unwound, that means selling American assets to convert back to yen and repay loans. That's direct selling pressure on American stocks. That's reduced demand for American bonds. That's a reversal of the flow that's been supporting prices for years. Japan had the lowest interest rates of any developed country. You could borrow yen at essentially zero cost. So hedge funds and banks borrowed massive amounts of yen, billions and billions worth, paying almost nothing in interest. Then they converted those yen into dollars and invested in American assets, stocks, real estate, corporate bonds, whatever offered a positive return. Japan currently has the highest interest rates they've seen in about 30 years. For Japanese homeowners with variable mortgages, payments are rising right now. Here's the systemic risk. If payments rise faster than incomes, people default. When defaults increase, home prices fall. When home prices fall, banks holding mortgage collateral become undercapitalized. When banks weaken, they stop lending. When lending contracts, the economy slows. More people lose jobs and default. Sound familiar? This is exactly what triggered the 2008 financial crisis in America. Japan's mortgage structure makes them vulnerable to the same cascade. The government knows this, which makes the February 8th decision even more difficult. Raise rates to fight inflation, but risk mortgage defaults and bank failures. Keep rates low to prevent defaults, but let inflation destroy purchasing power. There's no good answer. The Treasury connection. Here's the final piece that connects directly to American finances. Japan holds approximately $1.2 trillion in US Treasury securities, making them the largest foreign holder of American debt. During Japan's decades of negative interest rates, Japanese investors looking for any positive return bought American treasuries. Even a small positive yield was better than negative yields at home. This created a perfect arrangement. The US government needed buyers for its bonds, and Japan needed somewhere to invest. But now conditions are changing. If Japan keeps raising interest rates, Japanese government bonds start offering competitive yields. Japanese investors no longer need to accept currency risk and invest abroad to earn positive returns. They can invest at home. If Japanese investors shift from American treasuries to Japanese bonds, that's $1.2 trillion in demand for American debt that could disappear. When demand for treasury securities falls, prices fall and yields rise. Rising treasury yields affect everything. Mortgage rates go up, corporate borrowing costs increase, government debt payments explode, and stock markets often fall as bonds become more attractive. Japan's decision about their own monetary policy has direct implications for American interest rates, housing costs, corporate profits, and government finances. The two economies are deeply connected, and that $1.2 trillion in treasury holdings is the link. What this means for you, look, I'm not going to tell you what to do with your money. That's not my job. My goal is to help you understand how the system actually works so you can make better decisions for yourself. But here are some frameworks worth considering. Geographic diversification may matter less than you think. If Japanese monetary policy affects American stocks, owning both Japanese and American assets doesn't fully protect you. The same dynamics move both. Interest rate sensitivity matters more when rates are actually changing. After years of near zero rates, many assets were priced assuming that would last forever. As rates normalize, those assumptions get tested. Currency exposure is real. If you hold assets influenced by yen dynamics, currency movements directly affect your returns, and debt levels constrain options. Countries with massive debt have fewer tools when problems arise. They can't easily stimulate if they're already borrowing heavily. The bottom line. Japan's February 8th decision matters because it reveals the core tension in modern monetary policy. 30 years of fighting deflation created a debt burden that now limits options for fighting inflation. Negative rates that seem sustainable without inflation become impossible when inflation arrives. Capital flows that supported American asset prices could reverse. Treasury holdings that funded American deficits could shift. None of this is certain, but the structural dynamics are worth understanding, because whether or not this particular decision triggers immediate consequences, the underlying tensions between debt, inflation, and growth will keep shaping markets for years. This is what I do on this channel. I break down the mechanics. I explain the connections. I help you think in systems rather than react to headlines. Because understanding how the system works before you need to react is the foundation of making decisions you won't regret. If you found this valuable, hit that like button and drop a comment, letting me know what financial topic you want me to break down next, and subscribe so you don't miss the next one. Thanks for watching.